There are two types of beginner investors. One spends 3 years picking individual stocks, gets it wrong half the time, and eventually gives up. The other buys one single fund on day one and quietly ends up ahead of most professional traders. The second person didn't get lucky. They just used an ETF. Let me ask you something first. If I handed you 100,000 Naira right now and said, go pick 5 stocks that will beat the market for the next 10 years, could you actually do it? Be honest. Most professional fund managers can't even do that consistently, and they do it for a living. So what makes anyone think a beginner picking stocks based on vibes and YouTube comments is going to get it right? This is exactly the problem ETFs were built to solve. Here's a quick way to picture what an ETF actually is. Imagine a fruit basket instead of a single fruit. If you buy one apple and that apple goes bad, you lose everything. But if you buy a basket with an apple, a banana, an orange, and a mango, one bad fruit barely matters. The basket as a whole still holds up. An ETF is that basket, except instead of fruit, it's holding dozens, sometimes thousands of different stocks bundled into a single investment that you can buy with one click. Today, I'm breaking down exactly what an ETF is, how dividends work inside them, and the one number, fees, that quietly decides whether you retire early or retire poor. By the end of this video, you'll know exactly what to look for before you buy your first ETF. Let's get into it. So, what exactly is an ETF? ETF stands for Exchange Traded Fund. It's a single investment that holds a basket of other assets, usually stocks, sometimes bonds, and trades on the stock exchange just like a regular share. When you buy one share of an ETF, you're not betting on one company. You're instantly spreading your money across everything inside that basket. Let's make this concrete. Say you buy an ETF that tracks the top 500 companies in America. With one purchase, you now own a tiny sliver of every single one of those companies. The banks, the tech giants, the retailers, the energy companies, all of it. If 10 of those companies have a terrible year, it barely dents your investment because the other 490 are still doing their job. That's the entire point of an ETF. Instead of betting on one horse, you're betting on the whole race. Now, here's something a lot of beginners don't realize. ETFs pay dividends too. If the basket includes dividend-paying companies, all of those individual dividend payments get collected and passed on to you, either as cash deposited into your account or automatically reinvested, depending on the ETF and your settings. So you're not just getting the safety of diversification, you're often still getting paid along the way, exactly like owning individual dividend stocks, except now it's coming from hundreds of companies at once, instead of just one. Let's talk about two different flavors of ETF dividends, because this trips people up. Some ETFs are labeled distributing, which means the dividend gets paid out to you directly in cash, usually quarterly. Other ETFs are labeled accumulating, which means instead of paying you cash, the fund automatically reinvests those dividends back into the basket for you, growing the value of your shares instead of sending you money. Neither one is automatically better. It depends on whether you want income now or growth later. If you want cash flow you can actually spend, pick distributing. If you want to leave it alone and let it compound for the next 20 years, accumulating usually does that job automatically for you. Now let's get into the part that decides whether ETF investing actually makes you money. Fees. Every single ETF charges something called an expense ratio. This is a small percentage taken out of your investment every single year, automatically, whether the fund goes up or down. It sounds tiny, so people ignore it. That is a mistake that costs people literally hundreds of thousands of dollars over a lifetime, and I'm going to show you exactly why. Say you invest $10,000 into an ETF with a low expense ratio of 0.1%. Over 30 years, assuming decent market growth, that fee barely dents your returns. Now take that same $10,000 and put it into an ETF charging 1.5% instead, which sounds small, almost forgettable. Over 30 years, that difference in fees alone can eat away tens of thousands of dollars of your final balance. Same market, same investment amount, same time period. The only difference is the fee. And that fee difference is the single biggest reason two people investing in the same thing end up with wildly different results decades later. Here's the rule I want you to actually screenshot. A good, low-cost ETF usually charges somewhere between 0.03% and 0.2% per year. Anything creeping over 0.5% to 1% needs a very good reason to justify itself, because you are giving up real compounding for something that in most cases doesn't outperform the cheap option anyway. Checking in funds expense ratio takes 10 seconds. Search the ETF's name plus expense ratio, and it's right there. So how do you actually pick a good ETF? Two things to check every single time. Step 1. Check the expense ratio, like we just covered. Lower is almost always better, especially for long-term buy-and-hold investors. You are not paying for luck. You are paying to own a piece of the whole market, so there's no reason to overpay for that. Step 2. Check what the ETF actually tracks and how diversified it really is. Some ETFs sound diversified but are secretly concentrated in one sector, say 90% technology stocks dressed up as a broad market fund. Look at the top 10 holdings and what percentage of the fund they make up. If 10 stocks make up 60% of the entire ETF, you're not nearly as diversified as the name suggests. A genuinely broad ETF spreads your risk across dozens of industries, not just one trendy sector. Quick note for anyone investing from Nigeria, you can access many popular international ETFs through platforms like Bamboo, Trove, or Chaka, alongside NGX-listed options. The same two rules apply no matter where you're buying from. Check the fee and check what's actually inside the basket. Now let's put this all together with a simple recap you can screenshot. 1. An ETF is a basket of many investments bundled into one, which spreads out your risk automatically. 2. Many ETFs pay dividends, either straight to you as cash or automatically reinvested, depending on whether the fund is distributing or accumulating. 3. Always check the expense ratio before buying, because a fee difference that looks tiny on paper can quietly cost you tens of thousands of dollars over decades. And 4. Check what's actually inside the ETF, because diversified isn't always as diversified as the name makes it sound. If this is starting to make sense, drop basket in the comments so I know you're following along. Here's the honest truth about ETF investing. It's not exciting. There's no dramatic story of picking the next big stock before everyone else. It's slow, it's boring, and that's exactly why it works. You're not trying to outsmart the market. You're buying the entire market, paying almost nothing to do it, and letting time do the heavy lifting. If you're just getting started, you don't need 10 different ETFs and a complicated strategy. Pick one low-cost, broadly diversified ETF, check its fee, check what it actually holds, and let it sit for years. That's genuinely the whole strategy that quietly builds most long-term wealth, not the exciting stock pick, the boring basket you never touch. Let me know in the comments what you want broken down next in this beginner series. And if you want to see how dividend stocks compare to ETFs side by side, check the next video where I walk through exactly that. See you in the next one.